Social media interactions become interesting only when it is two-way. You must get a fair chance to interact with the person you follow or the person whose videos you watch. I have started this new initiative, Ask Milestones to Wealth Anything, AMA in short, through which all of you can stay in touch, ask me questions you like to ask, clear your doubts on personal finance, learn more about Milestones to Wealth and about our PMS products, and stay connected. So this brings us closer. I'm able to be closer to you, to help you in whatever way I can. You feel closer by asking whatever you wish to, and we grow together, helping each other along the way. So fill in this form and stay connected through Ask Milestones to Wealth Anything. I was going through the broad trends in the Indian stock market from Jan 1 to June 30th, and these three data points were very, very interesting to me. The first one, in 6 months, the Nifty 50 returned 8%. The Nifty Midcap 100 returned 4%. And the Nifty Smallcap 100 returned 1.8%. While this data point was just casually mentioned in the newspapers in a small box column and was not really screaming at me from the headlines, I saw something else that was screaming at me on social media. All these were data points taken by individuals by deciding the intervals of time very, very convenient to them. One index said that the Nifty beat the Nasdaq 100 over 5 years. I was thinking, is this in rupee terms or in dollar terms? Isn't that the right way to evaluate? But what were we doing? We were only taking an apple to orange comparison. We were not comparing the two in the same currency. Then there was another comparison where another friend was comparing the returns from small cap with the index. The timelines were chosen to show small cap in great light. Now we have hundreds of videos like these on social media which get put out regularly by numerous people who want to establish a certain point of view. They want to say that my view is correct and this data point seen in this way supports my view. In my opinion, everybody is entitled to that view. I'm not saying that somebody should not make a video like that. But as an investor, should you give importance to that video? Suppose you're going to see that video and say, from tomorrow I'm going to put all my money in small cap. You could become the patsy. Here's why. Firstly, however much we torture data and torture them to convenient data points and time intervals, that is not going to guarantee what we are going to achieve as investors if we take actions based on these data points. So seeing this past data, if you say that I am going to invest only in small cap because over this particular 12 or 15 month interval they have rocked, that means nothing. I gave the data points in the beginning of this video relating to this 6 months only to highlight how data points, when inconvenient to us, can completely destroy our narrative. I am also a participant in this industry. I do have at least 6,000 people to whom we give equity fund recommendations. And here is my position. I have not recommended a single small cap fund in a while. to any client. In fact, I discourage investors from chasing small cap mutual funds. Mid cap is a little bit nuanced because mid cap investing happens directly in mid cap funds. Remember, in recent times, in the last year, 10% of the capital that came into equity went into mid cap funds. And it happens to be the highest amount of funds going into a single category. So everybody has favored mid cap directly. Over and above this, there is a lot of mid cap investing happening through both multi-cap funds and flexi-cap funds. So it's not 10%, it's much higher. And please remember that all this money is going into only 100 stocks. Despite so much money going into 100 stocks, the mid-cap index could not beat the Nifty and underperformed the Nifty by 400 basis points in the first 6 months of this year. What does this tell you? This is what I would like you to think. I would definitely want you to comment in the comment section as to what your observations are, what your thoughts are, and what you think is the way forward. Because this discussion should be open, transparent, and organic. So, too much money going into mid-cap directly and through funds like flexi-cap and multi-cap. There is also a lot of mid-cap investing happening in asset allocation funds, in hybrid funds, and even in large cap funds because they are allowed to invest 15% outside of large cap. So, the extent of mid-cap investing that is happening in our country right now is at a historic high, and still mid-cap index, despite receiving so much flows directly and indirectly, has not been able to match wits with the Nifty. There is a message in that, and I want you to read that message. The other message is that small cap has already underperformed despite receiving very strong SIP flows. I am told the highest amounts go into small cap out of the 26,000 crore monthly SIP book. If not the highest, it will at least be the second highest. So, despite receiving regular capital, it is a space that is underperforming. Now, I clearly anticipated this, and that is why I have been safe zoning my 6,000 investors away from these two spaces. It's a conscious choice. If I choose to torture data, I would also be able to give data very convenient to invest in these places. But I felt that there's only one thing that matters. Only what happens in your portfolio counts. Only returns matter. So we stuck only to large caps. And that is why our investors are in a much safer zone in equity in this calendar year. And they've been able to hold on to their gains in the previous year in their mutual fund portfolio. And because we chose a multi-asset approach, they have actually made money even in this calendar year. Friends, narratives don't make returns. Past performance is not going to give you returns in the present or the future. What really matters is your portfolio positioned correctly for the present and the future? Because only returns matter.